Good afternoon, and this is the second most dangerous panel after lunch is called the graveyard shift. We are soon thereafter, but hopefully in the next 30 odd minutes, 40 minutes, we won't bore you. I think what we're here to discuss really is a lot of small and medium businesses need to access finance, and one of the big reasons why MSME and SME growth is stifled in a very competitive market is the lack of funding and finance. What we have is a pretty good panel, in fact, a good mix of three from the kind of venture capital space, two from banking. We have representatives from IDBI, which is, yes. So there is Vikram from IDBI. We've got Sailesh from Exim Bank, who's on the extreme left. And then right next to me, there is Vivek from VentureGarage, which is a fund. There's Brijesh, Damodaran from Auxano, and the gentleman in between the two bankers there is Rishi Srivastava. He also runs an early stage fund. So quickly, what we want to tap upon is two things. One is, when is the right time to go for funding, and what is it that a startup needs to do? But before that, as a quick introduction, I want to get each of our panelists to tell us about what is it that they look for when they seek out small, medium businesses for funding, right? And on a broad basis, I would just say that VCs typically have an exit time framework, 5, 7, 9 years. In banking, which is kind of more debt-based, it's slightly more longer term. But I'll let each speaker, say his piece first. So why don't we start with you?
Hi. See, at the core, obviously, we're looking for a great founder. I'll tell you what a great founder to us means. We're looking probably for somebody who's really obsessive. Somebody balanced is probably not a positive word for us. We're looking for somebody who's almost crazy about what he does, and probably thinks he can change the way things happen, or probably will change the world, or make some dramatic change. So we're obviously looking for that kind of founder. So he should be knowing, the way we judge that is he should be knowing a lot more about his subject than anybody else I know about that subject, right? What he or she is doing. The other thing we look for is at least some level of corporate governance or honesty in the system, because that's another thing in India is a slight rarity, right? But those are, I think, if we find that, the rest is sortable in my viewpoint. Of course, we are looking at a good industry or a good space, a space which potentially can become large and potentially can grow. But pretty much that's it.
So one little counter or one additional add-on to that, Vivek, is that venture capitalists are normally accused of looking at very early stage businesses and looking for that big hockey stick growth, right? So when 2x becomes 10x and then becomes 100x and then you exit. A lot of small and medium enterprises in the traditional Indian context are businesses that have a steady state for years, right? They may be small businesses, but they are profitable, run by a family kind of organization. Why is it that VCs don't actively seek such organizations, right? This is more steady, this is profitable. What holds you back?
It doesn't really matter. By the way, there's now a different set of people who invest in stable businesses. So, you don't need to go to a VC if you're an SME doing 50 crores with 10 crores of PAT. There are enough family offices who are looking for you. So that's really changed in the last 3-4 years. It was not there in 2017 when I started. First few years it was all that sort of ecosystem. But in the last 3 years, the amount of liquidity which is available in the market for profitable businesses which can potentially grow, I think it's infinite. I mean, it's your capacity really to attract that capital, but the availability is dramatic.
Rishi, I'm going to come to you, and therefore I just want to get a sense. So Rishi kind of typically looks at slightly more deep tech startups, but has certainly a much wider perspective. He spent 16 years at Microsoft, so he understands the space. So Rishi, how does your fund, how do you look at the entire funding space?
Yeah, so I think as Vivek mentioned, obviously the entrepreneur is very important, and all of you are entrepreneurs. Actually, all of you are successful entrepreneurs. So yeah, that's the starting point. But I think I think there are three vectors really that that one would look at, and this depends also on the industry you're in. But if you're in the technology industry or you're into something that's creating some kind of IP, and IP doesn't mean only software. IP can even be in MSME. There are lots of great examples of IP even in India. So I think that's one other thing is the value add, right? How differentiated are you? I think that's the first one. The second one, in addition to of course the entrepreneur, right, is the fact that have you been able to establish a business that the proof, the product market fit or the services market fit has been there. I think that's the number one thing as an investor you look for, right? Because then you'd like to actually invest in helping scale and grow that. And that, what does that mean? So many people ask me this, that everybody says product market fit. What is product market fit? Well, product market fit, in a country like India, if you have a bunch of customers who are paying you for something, then that's product market fit, because nobody in India likes to pay for anything, right? So that's really the starting point. So if somebody is consistently paying you for something, then you should look inside and figure out that there is tremendous value you're adding. Because in this country, we don't like to pay for anything, really, and including myself, because that's how we are. It's not a bad thing. It's perhaps a good thing, which fosters a lot of innovation. So if you see, in India's driving innovation in many areas, because we're a price-conscious market, not because we are cheap, but because we want value. So I think that second piece, that third piece is also just as important, for us to look at. Because if we know if that is established, then just applying a little more capital to it is going to really lead to the hockey stick you were talking about.
Thanks, Rishi. So Sailesh is from Exim Bank, and I think they look at the whole funding space slightly more differently than, so I would say more patient capital than VCs who are a little bit more impatient in terms of growth, in terms of exits and such like. Sailesh, do you want to talk about how does Exim Bank approach the MSME or the entire ecosystem in terms of funding? How different is it philosophically, and what are the things that you all do to encourage entrepreneurs?
Thanks, Lloyd, and thanks, Business World for having me here. So just to tell, in fact, Exim Bank is an export credit agency owned by Government of India. So we do many kinds of funding. Primarily, we are a lender, so provide debt to large, small, medium, all kinds of company. So 3 years back, in fact, we came out with a program called Ubharte Sitare program, which is a very contextual in this context and which I head. So that is why I'm here. So in this, what we realize that many of the SMEs, and particularly the emerging corporates and the startups, they have challenges in terms of access to credit, and equity as well. So access to credit from the formal, the banks, because of the collateral issues, because of many issues, in fact. So we came out with a kind of a wholesome solution wherein we will look at the company, and under this program, in fact, what we look at primarily is the company should have been, one is the deep tech, okay? Company should have a differentiated technology, differentiated process. So not any like trading, run-of-the-mill SMEs we do under this program. So, and they have opportunity and they have potential to scale themselves. So that this is where we, come in play, so that our, by way of support, by way of debt or equity. Under this program, we do debt as well as equity. So likes of example, in last 2-3 years, in fact, we have funded almost 100 such kind of companies. So what we do to look at how, because as a typically banker, in fact, will not understand the technology in depth. So we'll have a, we have in-house advisory panels, in fact, taken from various academic institutions as well. So that's the differentiation which we bring. And we work very closely with academic institutions, incubation centers also. So likes of IIT Mumbai, IIT Delhi, in fact, I am Ahmedabad, ISC Bangalore. So we work very closely with them and cater to their incubating company, how we can, help them. So idea behind what differently we do is basically, we as a typical lender don't only look at for debt funding, but we look at a patient equity funding as well. And it's not unlike the venture capital wherein you see that they have a 3, 5, 7 years, horizon to exit. We don't keep any horizon, to be very frank, because we want them to scale up and grow. The whole, and we see a lot of companies from the defense side, from the electronic sides. In fact, many innovations are coming. Like Pune, Bangalore, these are the hubs. In fact, Delhi, Gurgaon, these are the hubs And where we see, in fact, many companies, as my previous, speakers have said that man behind or person behind or, behind the any startup, which matters most. So that definitely matters for all of us, not only for equity investment, for lending as well. So it's that person, in fact, you should get the spark when you meet the person, that yes, he can scale up. So, or she can scale up. That's the intent behind it. And obviously, we are not coming at a stage where, it's a pre-revenue sort of stage. So we see that, some revenue is there and some growth is happening and product is already established. So those kind of things we see, and then we look at funding it.
Thanks, Sailesh. I think that's a great overview. Brijesh, coming to you and Auxano Fund, how do you all assess the spark in a founder, right? I think Sailesh did mention that aspect. And do you all kind of look at certain priority sectors? So what's the big driver in the selection process? Is it the sector? Is it the promoter? Is it the kind of the ease of return? Just talk us through a little bit of Auxano's process.
Yeah, namaskar. Thanks for this. And this is a good question. And let me put it this way. In respect to what has been shared, I'll not repeat that, but let me put it this way. We all invest to get return on capital and return off capital. No one talks about it, but that is very important. So let's not forget that. So none officer is an NGO or a social responsibility. It is there, but as a VC, is responsible that we carry fiduciary responsibility. So that is very important when you put in. So this is besides what has been shared by the panelists. The second point is that when you're looking at, are you looking at emerging megatrends? So emerging megatrends, and then within these megatrends, is it a category creator, market creator, or market owner? So it looks very simple. It's actually very simple. Fortunately and unfortunately, when you are investing in a venture business, you are talking about 5 to 7 year kind of a minimum horizon. I was in Kolkata yesterday and they said, "Kya 2 saal mein bata kitna milega?" Bola paisa hi mat dalna. Because this is not a quickie. You need to have patience, and it's at the long tail where the hockey curve comes into play, and you need to have patience. So you cannot buy growth. Buy growth has its own challenges, but let's be very clear. There is enough and more capital, and that is where, as a promoter, I'll not say founder, because promoter actually creates and builds it up. You need to know, you need to understand, and you have to be a chief storyteller. You have to bring that vision, what you have, among the investors and say, this is your vision, and why don't you put in this and move forward? So that is very important from that perspective. So if I want to summarize, I would say, and it's elementary, like what has been said, promoter, founder, horse, jockey, all of that. Plus, what is the megatrend coming into play or in for the long haul? Is it a category creator? Is it a market creator, market owner? How it can grow? And finally, can we have the return on capital and return of capital? One of the biggest things is that as a promoter, you need to decide and choose from whom I need to get the money from. Do they share the same vision and same approach? And second part is that, can a follow-on capital can also come, or can the follow-on capital be arranged by your existing investors to come into play? So these are very elementary, but then in the rush to be there, you miss some of the elementary points. So, and today let me share, there is enough and more capital out there. A lot of family offices are willing to put the patient capital. The only thing is that you walk the talk, you have governance in play, you share the data points upfront. Bad news are to be shared upfront, and I don't see why we cannot grow big and bigger. So a no is a yes also many times. So from that perspective is something which one should look into.
Thanks, Brijesh. That's helpful. Vikram, coming to you, and in a sense, you kind of straddle both worlds. At its core, IDBI is a developmental bank, but within that, you handle a kind of a sharp portfolio of shorter-term funding. So you are a kind of VC embedded in a bank, in a debt ecosystem. How different is your approach?
Thank you for giving us this opportunity. So at IDBI Capital, which is a wholly owned subsidiary of IDBI Bank, we manage these alternative investment funds, which invest and focus in defense, aerospace, deep tech industries. Total AUM is around 700 crore rupees. Coming to your point, I think the fellow members, panel members have adequately covered the point. but we as a investor would like to see the project, people around it, how flexible the people is, because see, end of the day, it's all about investment in innovative projects, and things might go wrong also. We don't know, but taking the U-turn at right time is very important to safeguard the project. Otherwise, end of the day, we'll have to write off the entire thing. Second, as you rightly mentioned, adequate liquidity is available in market thanks to our recent union budget also, wherein the debottlenecking is happening when it comes to funding to MSMEs. Uh, what we look is what value addition we can do in addition to providing the financial funding to those companies. So that's an additional point I would like to keep.
So both, or most of the speakers had a recurring theme that there's adequate capital available, right? And, I can sense, and from what my understanding goes, a lot of MSMEs struggle to get capital, right? So there seems to be a bit of a dichotomy there, right? And therefore, just want to kind of probe a little deeper. Why is it that the biggest stifling for growth of MSMEs in India is the lack of capital? Very often, as you go into smaller towns, cities, they're dependent on the local bank and the vagaries of the bank manager, who may have his own priorities, who may have his own reasons for turning down. Maybe his appraisals are based on the quality of bad assets. Why is there such a vast dichotomy? So if we say that there's so much of capital, is that capital chasing too few startups who are right in the front page of Economic Times and the well-known names, as we all know, who go through crazy valuations? Or is it that a lot of, and this is more to the VCs on the panel, a lot of this capital is actually looking for quick gains in quick cities, not willing to go deep and go hard to understand a lot of innovation that happens in smaller parts of India, or less savvy founders who can, stand up, speak, fancy English and run a PowerPoint. I'll start with you, put you on the spot on this, Vivek.
Once again, let me iterate, there's enough capital available. I'll tell you why I think it seems like there is an accessibility issue. One is, so see, in the last 2 years, we've taken, I think, 9 of our portfolio companies to an IPO. I think hopefully 2 on the main and 7 on the SME. The biggest challenge we face is, first and foremost is, and it's not on the founder, it's the way our system is that there is major misreporting of income. So in most cases, it has taken us 2 to 3 years. See, you have to understand this biggest difference between what a chartered accountant will tell you and what the investment game is all about, right? So a chartered accountant will tell you, profit kam dikhao, kyun tax kam dena padega. We are exactly the opposite. We say for every 1 rupee of profit, we will give you 20 rupees of value. So we want you to, so that's why in the stock market you see scams of over-reporting profit, not under-reporting, right? Because the stock market doesn't suffer from under-reporting of profit. So that's the biggest challenge. The biggest challenge we face, I will not name the company, but let me not name it. But they're a company, by the way, small town. So they're a company based in Uttarakhand. We met them, I met them 3 years ago. A great founder, really, really passionate. He's exporting honey, does about, 150 crores of honey export every year, manages 15,000 beekeepers. If you meet him, you will see the passion he has. But it took us 3 years to get his act together in terms of getting his financials right. The amount of mismanagement was there in the company to convince him to recruit a CFO. It took us 2 years to get him to get a CFO on board. Now, I'm not saying these are right or wrong. The challenge is that the ecosystem of the SME is not aligned for them to attract this capital which is available. And that's the struggle. If you actually can, if you're willing to align that, if you're willing to align your corporate governance, really report what's happening, and small towns, right? This is Uttarakhand, before this we're talking to another company in Lucknow, hopefully we should hit the IPO next year. But that company will probably do 50, 60 crores of profit next year. But it takes us so many years to get them to start believing in this process. I think that's the biggest challenge we face, but we're patient because if it unlocks, all of us make a lot of money, right? So,
So I'll take this to you, Rishi, and therefore what I'm hearing, Vivek say, and I totally, empathize, is that a lot of entrepreneurs in smaller towns and such are not really ready, and that could be a combination of factors. Like one, like you said, is because they're used to running it as a proprietor-driven business where you run the whole thing. The second part is they don't have the resources to get proper CFOs and such like in place. And the third, which is often unspoken, is the fact that a lot of entrepreneurs fear losing control. As long as it's my business, I can do what I want. The moment I get an investor, questions are asked, they might demand a seat on my table, they will qualify. So where do you think, what is your take on that, Rishi?
No, it's bang on, actually. And I think this is not only small cities, even in the big cities, some of the largest promoters in this country have that ownership mentality. So let's not tell only the MSMEs, that's the way. I used to work for a multinational, right? And countries like Mexico were run by 5 families, Philippines, 5 families, Indonesia, 10 families. So this happens everywhere in the world. It's, So, but coming back to this, to MSMEs, I do think that there are 2 things that really make it difficult for them to access capital of this variety. Not from the banks, but certainly from venture capital or private equity. One is, this ownership mindset, and there's nothing wrong with that. Again, the fact is, if you or your family built that business, with blood, sweat, and tears, with all the tough times that you went through, you have the right to decide whether you want to give that control up or not. So that's very clear. And I do believe, and I think we were talking briefly outside, right, about this as well, as there are so many businesses in the hinterlands, in the tier 2, tier 3 cities, which are already doing very well. As the Indian economy grows, a rising tide raises all the boats. And I think a lot of our MSMEs are already doing super well. It's amazing when I travel and I meet people, and I speak a lot to people. And if you're on a train and you speak to somebody, when I was growing up and I got into the work, if you were a 100 crore company, you were damn big. Those used to be the large, 3 or 4 family businesses. These days, you get into a small town and you can meet people who are doing 200 crores, 250 crores, 300 crores of business. And these are businesses that are super profitable, which many of us in the VC community are not used to seeing, at least in the initial stages. So I think that ownership mentality is one. The second is a mindset, which is, growth mindset versus a status quo mindset. Now, you take a business that's doing, let's say, 100 crores of revenue, making, 10, 12 crores of profit. Typically, the promoter also gets a decent salary, quality of life, etc. You might want to argue that, why do I even need this capital? Although, India is growing and I could grow faster. But fortunately, my personal experience is that people are moving away from that mindset, more so the second generation, which is now very, very active, and they want to build something leveraging capital which is outside of the family. So I think these are really the 2 things. One is the ownership, the other is the mindset. And actually the mindset drives that ownership also. So it's only one thing, it's your mindset. Do you want to just own something which is a small pie, own everything of a small pie, or be part of a journey where you can see it flourish in much larger. So I think that's just, my view on this.
Great perspective, Rishi, thanks. I'm going to come to Brijesh on the same point, but with a slightly different angle. I think one aspect is about finding the right kind of entrepreneur, right kind of founder, right kind of organization to invest in. And certainly keeping the audience in mind, we'd like to look at what is it that a early stage business should do to get that. But I want to come to you specifically, Brijesh. The other challenge is, how do funds like yours get enough investors with the patience and the risk ability, right? In a country where, all things equal, your mutual funds and stock market growth itself gives sizable returns. Why should people allocate money in their portfolio to high-risk funding like startups, right? Specifically, as we hear about, entrepreneurs having their own temperament, their own issues, their own, perspective. They like to run the business the same way, right? Money is good to have for growth, but I still want to have full control. So is there a challenge in terms of building the fund?
Absolutely. What I'll go back, if you go to the US, you have more private equity funds, venture funds, as compared to what we have in the listed space. And so for a fund manager in the US to get that alpha is difficult. But what happens in the US is that, in the PE space, the company is there, by the time they get listed, it's more than fairly valued. Other part is that today, when you're looking at stock markets, you have got easy liquidity. And when you have got easy liquidity, you can come in, get out anytime. Plus, there is a lot of transparency in terms of data being available and the way it is being regulated and shared. So compliance, because of the regulation is there, gives a lot more comfort as compared to what we talk about the venture capital. In venture capital, it's the Johari windows, unknown unknowns. or the known unknowns. So how do you, navigate that territory becomes very important. So that's where you have your own, playbook. We have our own playbook. And trust me, we make mistake every time. But the thing is that you should not repeat the mistake. And having said that, you still grow. Then again, looking at the page, okay, what is it you're talking and sharing? So if someone says, offer me, okay, I'm committing you X amount of, you're very clear, like, the VC space, gives early capital to disruptors, and it's not a 2-year, 3-year game. It is a 5, 7, 9-year game. And many of them can fumble, many of them pivots, and if the pivots goes well, and then you're sitting on, multiple, X's. So that is where folks say power law, but having said that, it is now should go beyond that power line. So how do you identify that? So it becomes very important also to the promoters that how they build up and share. What we find lacking is that the storytelling ability is not there. We have grown up just by writing, but can you sell a story? Today, I would say promoters have much bigger avenue to get in touch with anyone, and same for VCs also, because the one-to-many has opened up big time. So can you be a brand? You are a personal brand. How many of us actually talk about it? How many of us make it a personal brand? We should come in front and talk about it, because that is where the first trust comes into play. And that's where, we are looking to create brand. We are talking more. We are saying in front, what is that? We are having our own governance role in play, how we share data, how we share information, and be transparent. The thing is that it may take some time, but it takes a community to make a person. So that's where we are looking to, and there's enough and more out there. It's only thing how we go about doing it, how do the storytelling right, and walk the talk. That's the most important part. But with so many mishaps, if I can use that word, happened over the last few quarters, the thing is that the transparency and the governance levels, are being sought more, and it is not, walk in the park. It's more like show me the money. That's what the whole is, and how we grow, and that is good overall.
So Sailesh, taking off from where Brijesh left it, how can small medium businesses access capital? How transparent is the process, let's say in your bank on all across? And what are the kind of steps they take before they decide they want capital, right? I mean, there's a trade-off. While you want capital to grow or to grow your business or to take money off the table, so to speak, you also are constrained once you get investors on board because of fiduciary responsibilities, the fact that you are no longer a family or a personal driven businesses. How do you, at what stage do you think entrepreneurs need to go out and access capital, and how easy is the process?
Yeah, thanks. See, each, I would say, a different, I have seen many of the journeys, in fact, those who are startup kinds of, those small and medium traditional side of business, and those who are already banking with, So in terms of, I would focus primarily on startup sides. And there's a challenge which, when they conceptualize the idea, comes to the ideation stage. Today, in terms of, availability of grant kind of funding, it's quite a lot. I don't know, I have seen some of the startups hitting to each and every government grant and getting them. It may be 10, 20, 30, 50, some of them goes to a crore as well. But some of the startups, they are very smart, and they don't raise any external funding, and they use till they become, to certain stage. Some of them, in fact, become profitable also with these grants. Availing this, go from ideation. I have seen those also cases. So it's in each startup's journey. In fact, the things are different. So how, frugal is the, I would say, how frugal is the, the person behind it, who are the founders behind, when they want to, how much they want to also dilute. All these, the context comes in play when they go and, borrow or look for the investment. That's one thing which, and obviously, if a kind of deep tech kind of startups, in fact, where, investment is quite a large, then they can't obviously get, then in the initial stage only they look for the external, funding in terms of investment, even before they become a, revenue generator. So, but typically what I would like to, tell startups and the small and medium sized company, they, in fact, I see that skewedness towards the equity side. In fact, they look for the BC, they look for the P instead of, and that becomes a easier route for them instead of looking at lending. Because I see many of the startups, in fact, they are for a growth capital. There are many of the lending options are also available. So likes of us, likes of NBFCs are there, maybe come at a certain additional cost, but definitely you don't have to lose the earlier control, because if you want to really scale up and look for the larger round of funding, if your control has gone, no, in fact, I see the VCs or P, they don't look at you at the later stage. So that's the challenge which we, in fact, we have seen in terms of, hitting to the, so in terms of when you feel the exactly growth scale, because yesterday I was, I met one, our supported company only from Delhi, I would say. They are, again, the incubating company from IIT. Very focused, and, they are into providing catalytic converter for reduction of, in carbon emission, in fact. And these guys, in fact, very youngsters. So in the beginning also, when they wanted, the proof of concept, everything was there, they came out. And they raised funding also, equity. But partly I found them, in fact, we gave them loan also. Okay. It was a loan of almost 20 crores, which set up their first factory. Otherwise, there is option of also, going to the private equity as well. And then they had to dilute substantially to get that kind of funding. So those options, though, lending always comes with compliance. Lending is not as easy as the, though private, though the investment side also, because a lot of capital is chasing there. So any good startup. So what I would say that startups, in fact, don't, only look at the investment, the equity funding, look at lending as well, so that you have a better control continuing. And when you want to scale up at a massive scale, then at that stage, in fact, you will get the better valuation also, and you will have to, kind of dilute your stakes lesser as well.
So good point, but just to probe a little deeper. So you're saying that debt is an option that even SMEs should look at, obviously, the first tranche. But the general feeling is, and I was listening to the previous, the fag end of the previous panel, is the concern is that debt is not easy to come by, right? Because of, whatever, various priorities and such like. The whole process is very cumbersome and such like. In a sense, at least once you hit the right circuits, equity funding happens far more smoothly. In fact, I like the point he made outside Vivek. He said it's like, taking it IPOs like crowdsourcing, your support. So why would you, how easy is it to access debt for a small and medium enterprise?
See, generally that's the perception. I would rightly, accept it, in fact. But what what we brought out, in fact, under our program, I would give you couple of examples which will help you to understand. Let's say a company like Drone, I will not take name. Drone company, in fact, they were manufacturing, they got a large contract, okay, defense contract. They had an option either going to equity or going to, raising a debt. Debt was definitely, because that time collateral is not there. Typically, if you are looking at a debt size of 20-30 crores, no lender will come forward without collateral. And in fact, we have government schemes like CGTMSC, and CGSS. Those schemes are there. Certain limitations are there in terms of quantum, in terms of which is now in last budget has increased. That may help, kind of accessing debt also in a better way. But what we did, in fact, we structure around a cash flow deficit funding. So we see that, because a buyer is a Ministry of Defense. So if you have an anchor buyer like this, you can design the structure around it and give them lending. So that kind of, I would say, not, designing the product around that is not there commonly available amongst the lender. That becomes a challenge, definitely. I do agree, in fact, at lender, at mass, in fact, would not be able to design. But there are institutions like us, in fact, we design it. So we have helped many of such companies like that. In fact, one of the Bangalore-based company, again, they got a contract, a huge contract from government of Armenia. And I would say that turnover of that company was around 20 crores. We gave them loan of 80 crores. Okay, that is a loan. We could have taken equity also at that time. But we said, let them grow. In fact, now we have looked at equity option as well. So we gave them, again, backed by escrowing the cash flow, ring fencing, all those exercises we did. And they also, it's a founder also understood the importance of what. So if the founder understands the importance of the debt and savvy enough and try to help also the lender, then the lender can design it nicely, in fact, and ring fence it and then support them. So that's how that company, to this year, in fact, within 2 years now, they will be clocking 500 crores turnover this year, and they will be looking at IPO next year. So that's kind of, so it's how you design a product actually. It takes time for debt to design. Unlike equity, you have a lesser compliance, lesser, regulatory compliances are lesser, so that becomes easier. But that's the take, in fact, that you have to decide on as a.
This round goes to debt, huh?
Completely.
Clearly.
Yeah. In fact, that growth story of the 500 crore, I'm sure all the VCs on the panel are going to have a quick word with you, Sailesh. But Vikram, quickly to you. So what are the tips you have for MSMEs in terms of accessing funding? What can they do to make themselves more fundable, so to speak, or makes it much easier for you guys to pick?
Yeah, so see, seed fund Series A round is available. We have SRI fund, HVCFL CEO sitting here. I know SRI fund has got a corpus of about 10,000 crore rupee, which they are investing in various funds like us, which in turn investing this fund in various companies. Now, there is a beauty of this equity investment. With the help of this equity investment of 1 rupee, a cascading effect of up to 20 rupees can be created. I'll tell you how. The same company which has got about 1 rupee of equity can raise another 3 rupee from bank in the form of debt. Because as sir mentioned, there are certain limitations in debts. They need to have some equity or some kind of cash flow availability has to be there. The same company will in turn give business to other vendors to maybe source some product or give or maybe serve their customers. There also they will create the business around it. They will pay direct tax, indirect tax. They will create employment opportunities, direct employment opportunities, indirect employment opportunities. Of course, support the GDP and growth of the country. So the cascading effect is there. Besides the equity fund, I think the CGT MSC scheme, as sir mentioned, which the limit is also increased now. There are some specialized schemes from some of the bigger banks of the country. SBI has got a dedicated startup scheme, which they are funding to even loss-making companies also, wherein funds are required for product development. It is not exactly in the form of grant, but product development fundings are there. Similarly, IDBI Bank has also got some product which they are funding to startups, of course for product development and in case if they've got orders for execution of those orders.
So one quick last kind of rapid fire, if I may, Rishi, I'll start with you. What are the 1 or 2 things that MSMEs need to do to access funding, from VCs?
First thing is think big, right? Really, really big. I think Sailesh gave a very good example of a company that, had a turnover of 20 crores, got 80 crores, is going to be 500 crores. So I think everybody in the room should imagine. And look, it's like, investors are like bees and, growth is like honey. So if you're going to be very ambitious on your growth, you will never have a problem of at least having people wanting to invest in you. Will they and will you take the investment is a different thing. So I think, that growth mindset, and I think you're in the perfect part of the world. We happen to be in the perfect part of the world for that. I really do believe, India for the next 30, 40 years, especially MSME, is going to drive, humongous growth, for this country. So that's one. The other thing is, you've got to be very agile. See, traditionally, if you look at MSMEs, it's just by virtue of having built the business grounds up, at times the ability to pivot, the ability to move faster. And I say this from my VC experience, right, is that most successful companies are those who can see an opportunity and shape their business according to that opportunity as opposed to waiting for the opportunity to happen their way. So I would say those are
category
the 2 things.
creators.
Exactly. So those are really my 2 quick ones.
Okay, quickly to you, Vivek. I mean, what are the 1 or 2, quick sessions that you can have?
No, so I think, of course, growth and speed of growth. And I think obsessive founders, founders who are really obsessive with what they do. They're almost, for want of a better word, crazy about the fact
But
that.
sometimes these obsessive ones are also not very okay with taking feedback, right? They know it all kind of thing. So do you face those issues as well?
So yes, by the way, we are very often okay with that. So I assume I'm not right most of the time, right? So fair enough. It's just that it's okay. I think there's two sides of the coin, right? Probably you would have done a safe job, right? The whole reason you probably thought or doing some sort of entrepreneurship is because you're a stubborn guy, right? You think, nahi, main to khud ka hi karunga, right? So that stubbornness also has the other side of it. I think that's not too much of a challenge for us because they're smart enough. They're smart, they're frugal, right? So we're looking for those kind of people, yeah? And they are the guys who can just grow like mad, right?
Yeah, which is what I guess investors have to remind themselves that you're not the smartest guy on the table. Very often it's the entrepreneur who's risked everything to grow a business. Brijesh, any closing thoughts?
Yeah, definitely. One is adapt and adopt because things are moving so fast that you don't know what's going to hit you. So, forecasting is not for any play. And the other thing is that when you're looking at a promoter, are you creating a Jagir or you're creating an Amanat? So that's very important, from that perspective. And that's it.
Terrific. I think we've tried to answer as many questions in terms of funding that's relevant. Maybe just with the organizer's permission, if we have time for a question, if there is one or two questions, we'll be happy to take that.